As the banking crisis continues to unfold, will it send the price of gold higher? And will the yellow metal continue its bull run even if the Fed pauses on rates? And will the gold bugs stay bullish, or are they facing some resistance? Hi there, I'm Pamela Ambler. Welcome to I See Your Trade. I'm joined by our resident expert, Oxford economics economist Alex Holmes, and our special guest, Shaokai Fan, head of Asia Pacific and gold head of central banks at the World Gold Council. In this episode, what's better than gold? Gold is ubiquitous. It acts like a commodity and a currency. Traders can use gold as a store of value, as a hedge against riskier assets, and perhaps most commonly for speculation. Let's dive straight into the data, and let's start with the basics. This is a spot gold US dollar chart. It shows how many US dollars a trader needs to buy an ounce of gold. And so what I wanted to ask you, Shaokai, is the current banking troubles that we're seeing unfolding, that is sending gold prices higher. How much of this is because of gold's reputation as a safe haven?
I think that's a big part of it. The current performance in the gold price is probably indicative of a couple of different factors. One, of course, is just the uncertainty and unease and I guess the potential for wider trouble caused by the banking failures we've seen both in the US and Europe. I think part of that reaction is investors reacting to that level of unease in the banking sector. But another part of it, of course, is also what the potential impact on monetary policy might be. Now that we've had all these troubles in the banking sector, the Federal Reserve might look to pause or maybe even reverse its interest rate policy. And that might have an effect on the gold price too, and also might be contributing to gold's rise recently.
And Alex, a big factor in what we're seeing happening in gold right now is what's happening in the US, inflation being one element, and of course how high the US Fed Reserve is prepared to raise rates, as Shaokai mentioned. What's a sense of where the Fed is going?
It's a very uncertain picture at the moment. So if we rewind back to early March, before all this financial tumult had started, then market expectations were that the Fed would continue hiking by around 75 basis points on top of the 450 or so that they had already hiked by since March 2022. Now that was roughly in line with what the Fed had signaled at their December meeting in their infamous Fed dot plot. If you fast forward just over a week following the collapse of two banks in the US and worries about Credit Suisse in Europe, now markets were pricing in rate cuts before the end of the year. And since then, market expectations have swung around up and down quite a lot. It's still a very uncertain situation. The Fed has to control inflation, and inflation is running rather hot at the moment in the US, but also has to keep in mind what the impact of this financial crisis has been, whether it is in fact creating a tightening in financial conditions and is essentially doing the Fed's job for it. So if we were to hedge our bets, our team at our US team at Oxford Economics are sticking with their baseline of more Fed rate hikes. But really, the only thing we can say with any certainty is that uncertainty has increased.
Well, gold responds to a lot of different factors. Interest rates is one of them, of course. I would say that generally speaking, higher rates are a headwind for gold and lower rates are positive for gold, simply because gold has no coupon and therefore higher interest rates raises the opportunity cost of holding gold. But that's not the only thing that gold responds to. There's, of course, underlying fundamental supply and demand factors. There is the strength or the weakness of the US dollar. There's a level of market concern and uncertainty in general, which drives people to gold as a safe haven asset. So interest rates are definitely part of the equation, but not the only part of the equation for gold.
And central banks are accumulating lots of gold at the moment. What does that tell you about how they're viewing the world right now?
I think that's a really interesting question because the central bank story with gold has been a major part of the gold story in the last 12 months or so. According to our data, 2022 saw the highest level of central bank gold buying ever, with central banks buying about 1,100 tons of gold on a net basis. So I think it reflects a couple of different factors that central banks are considering. One is just this increase in geopolitical risk after the war in Ukraine, after tensions in other places. I think central banks are reacting to that because gold, traditionally speaking, has been a safe haven. But also there's been a shift in how central banks are viewing political risk now, because after the Russian invasion of Ukraine, there were sanctions placed on the Central Bank of Russia, which is a step that many central banks did not anticipate. So now that this is definitely in play, I think a lot of central banks are saying, well, how safe are my assets? And what can I do to ensure that they're not going to be susceptible to any sanctions or freezing or barriers in the future? And then on top of that, there's just the general macroeconomic uncertainty, the higher inflation. Gold traditionally does well during periods of high inflation. So I think that a lot of central bank reserve managers have turned to gold for a variety of reasons, of which the three I mentioned are probably top of mind right now.
And Alex, can we read anything into what Shaokai just mentioned about whether or not there are recessionary risks to the U.S. economy?
Well, certainly when people put money into so-called safe haven assets such as gold, it's usually a signal that they're worried about economic slowdown or even a full-blown recession. But interestingly, talk of US recession actually started well before the current situation. If you actually are looking for a silver lining in the current situation, is that the US economy is facing the current shock on a relatively strong footing. And we didn't see too many impacts of the Fed rate hikes so far, notwithstanding some cracks starting to appear in the property market and in the tech sector. So we don't yet know what the impact of nearly 500 basis points of tightening in less than 12 months, not to mention the rate hikes that might yet still be to come. It looks like we're going to avoid some of a big systemic event, but you've got to think of those 4,000 or 5,000 small banks across the US that are a vital source of credit for small businesses and households. Will they have different lending standards now? And will they be as confident in extending out loans? Our view of Oxford economics that the US will eventually slip into recession.
And the recent spikes that we've seen in gold, Shaokai, are being echoed by Bitcoin as well, which we're seeing, Bitcoin often being referred to as digital gold. But given your knowledge, how are the fundamentals of Bitcoin similar, or is this a completely different asset we're talking about?
I think it's a completely different asset. There are some superficial similarities because both assets have limited quantity. They are often used as maybe alternatives to fiat currency or viewed as such by some investors, but their financial behavior and financial performance is very, very different. All you have to do is rewind to the day that Russia invaded Ukraine and look at the difference in performance of the two different asset classes. Gold went up because traditionally it is a safe haven during periods of intense strife, and Bitcoin did not go up. So I think that points out that the two asset classes are fundamentally different. It's also worth noting that although gold is a heavily traded financial asset, the largest single component of gold demand is jewelry. So there are a lot of non-financial uses for gold, and therefore those impact the gold price as well, which adds to its stark difference to Bitcoin.
And when the layperson thinks of gold, they think of, as you mentioned, jewelry or perhaps gold bars in a central bank vault. Of course, it's a very highly traded commodity. And you've spent many years working in global gold markets. So how has it changed over those years?
Sure. Well, that's actually a really good point because this year we're celebrating the 30th anniversary of one of our flagship publications called Gold Demand Trends, which, as the name suggests, looks at gold demand trends over the last quarter or so. And we've definitely seen major structural shifts in the gold market in the last 3 decades, some of which include the advent of gold ETFs, for instance, which came around 20 years ago. Before ETFs were on the scene, if you were, the average retail or even institutional investor, and you wanted to invest in gold, you'd think to yourself, well, do I have to go to a pawn shop maybe, or do I have to go to a coin dealer and buy physical gold? But with gold ETFs, they can easily trade gold on most trading platforms, and it's just become a much more easily accessible asset class as a result. Another major change has just been the growth of emerging markets. China and India are now the 2 largest gold markets in the world, whereas 30 years ago it was mostly Western markets. And these 2 economies not only have an insatiable appetite for gold and a cultural affinity for gold, but they also have large and growing middle classes. And they'll be able to continue to support the gold market going forward as well. And another major structural change we've also seen is that central banks, like I mentioned before, although they've been strong buyers of gold, they've only been net buyers of gold for the last 13 years, basically since the 2008 financial crisis. Before that, they were actually net sellers of gold for many decades. So now that central banks have swung to buying, that's another pillar of support for the gold market that wasn't there 30 years ago.
And you mentioned that ETFs have been fundamental for changing the gold market. Could you go into a bit more detail on that, please?
Sure. I think before ETFs came along, a lot of different investors had trouble accessing the gold market. If they wanted to invest in gold, maybe they'd have to go buy a bar or a coin or go to a coin dealer. But with the advent of ETFs, it's just made gold investing so much more easy. And it's really democratized gold investing as well, because now you just type it into your trading platform and you can get access to the gold price. Gold ETFs have really transformed how gold is traded and who buys gold, but also they've grown significantly in size. I think if you look at the total amount of gold holdings that are held through ETFs, they now rival some of the largest official sector gold holdings of gold as well. So I think the largest official sector holder of gold is the United States, and Germany is number 2. So ETFs altogether would be around number 3 or so. So they've accumulated a lot of gold over time too.
And what other investors have been expressing interest in gold recently?
I think a lot of different types of investors have been looking at gold recently. One trend we noticed last year was a lot of retail investors, specifically European retail investors, moving to physical gold, possibly as a response to elevated inflation levels in Europe, but also the fact that there's a war on their doorstep as well.
Traditionally, we've always heard of the mom and pop gold buyers as the Chinese investors or retail investors. So now European investors are a lot more active in the retail market.
I mean, yes, the Chinese, the Indians have all been major gold buyers, but actually the largest buyer of gold per capita are the Germans. They buy a lot of gold per capita. Given their financial history, they often like to use gold as a hedge against inflation. And I think that's been proven true last year as well. And then, of course, the geopolitical disturbances very close to their borders, I think, is giving some people incentive to add gold too.
And in the modern day financial world, do you think gold still lives up to its safe haven reputation?
Absolutely. I think gold has a well-deserved safe haven reputation. We've examined periods of financial stress over the last 30 years, and in almost every single instance, gold has performed well versus risk assets, and therefore it's a good thing to have in your portfolio as downside protection for the unknown, like we're experiencing right now with this banking crisis.
A big thank you to our resident expert, Alex Holmes, Oxford economics economist, and to our special guest, Shaokai Fan, head of Asia Pacific and global head of central banks at the World Gold Council. And there you have it. Gold is fundamental to the functioning of modern markets, but it's a complex beast that sometimes acts like a currency and sometimes like a commodity. One thing is for sure, it's been around for thousands of years, and there's no indication it's going away anytime soon. Thanks for tuning in to episode 1 of IC Your Trade. IC Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade out to IC Markets. Thank you for joining us today, and we look forward to seeing you next time.